US Federal Reserve pulled out no surprises at its first policy meet of 2020 as it decided to maintain the key overnight lending rate in a range of 1.5 to 1.75%. Let's do a three-point analysis to really understand the key fine print. 1. What's the Fed's outlook on economy? Well, the Fed commentary for the US economy largely remains on the similar lines as per previous occasions: a strong labor market, but weakness in investments, manufacturing and exports continues. Now, data also shows that US inflation still trends below 2%. The reading for household spending was a notable exception. It was seen rising at a moderate pace, implying moderation in assessment for the domestic consumption growth. Now, the Fed, however, noted that solid job markets, broad-based rising trends for wages, and upbeat consumer confidence are supportive of the household spending in the near future. Now, overall, the Fed also appeared positive on the developments so far on the trade front since last meet. In his press conference, Fed Chair Jerome Powell also pointed to signs of global economic growth stabilizing and also diminishing uncertainties around trade. It said that the policy would remain at the current level unless there is a material change to the economic outlook. 2. Liquidity support to stay. Well, following the money market volatility in September 2019 and thereafter, the Federal Reserve felt the need for higher level of reserves. This led to a series of open market operations to provide ample liquidity to the system. As a result, during 5 months, September 2019 to January 2020, there has been a liquidity infusion of about $350 billion by the Federal Reserve. Now, Powell also said that open market operations of about $60 billion per month will stay at least till April 2020 or till the time banks have ample reserves. 3. Economic sentiment is stabilizing. Well, trade outlook has improved after the US-China preliminary tariff deal. However, Powell also called for patience about its positive impact on the domestic economy. Now, it would require sustained reduction in trade tensions over a period of time for a positive spillover to the macroeconomic growth. Other than China, the US is already in talks with other trade partners such as the European Union and India. Now, this means that the trade policy uncertainty is still elevated. Now, Powell also suggested that the leading indicators such as manufacturing PMI for many countries are also witnessing some stabilization. In few cases, growth is also seen to have bottomed out. All that said, the coronavirus outbreak in China has emerged as the key risk to monitor for global growth. Now, we at Moneycontrol believe that the Fed meet reaffirms its accommodative stance with the guidance of providing ample liquidity to money markets in the near future, as well as its commitment to the 2% interest rate goal in a consistent way. Now, as per CME Fed Watch tool, the probability of a further rate cut is higher than 60% towards the end of this year 2020. Now, Fed's commentary also suggests that the threshold for a rate hike is sufficiently high, so only when inflation really goes past the target level and remains persistent there for a while, only then will it make for a case for a rate hike. Now, thus, Powell's lower for longer narrative also for interest rates continues, which should be positive for risky assets classes unless the current epidemic in China or any negative surprise on the hard economic data derails this thesis.